Stocks closing out an up and down week with a mixed session, as I just mentioned, led by the blue chips. The Dow managing to hold on to gains for the week and the day as well, while the NASDAQ composite fell 2% on the week. Joining us now is Unlimited CEO Bob Elliott. Bob, great to have you here on set.
Nice to be here.
I want to get your thoughts on what we've seen in the markets. We've been having a lot of discussions in recent days about the fact that this is a market that was due for a pullback. How do you see it?
Well, we started to see a little bit of the markets starting to create that tightening. Rather, the Fed has kind of backed off a little bit and said basically they're done for now. And then we've gotten enough move on the long end to start to create some financial market tightening. And so what you're starting to get is those high flyers are feeling the effects of that market-based tightening and are starting to come down. That's why what we're seeing is we're seeing the tech stocks underperforming, and we're actually seeing energy stocks outperforming, stocks that had lagged for much of the year.
Is that a trade that's sustainable here?
Well, I think so, because what we're seeing is the strength of the economy is continuing to flow through. You're seeing those commodity prices continue to rise, right? A great example is, this week, commodity prices, oil prices up 7%, as you noted, and that's really supporting those stocks. At the same time, you're getting tech stocks, we're talking about PEs at 40, right, for the tech sector, for the XLK ETF. How does that look in an environment where we're starting to actually get that tightening of monetary conditions, that long end rising? It's going to be tough to maintain that high flying in that sort of environment.
I mean, you're starting to see, look no further than the PPI reading this morning. That was a little bit hotter than expected. You're starting to see whether it's oil prices, whether it's some aspects of services inflation. It's starting to look like it could potentially be poised for a reacceleration here. What does that mean, not only for the Fed, but also for the markets when you've seen yields creep back up, you've seen the dollar strengthen, and you have seen some of these commodities move higher too?
Well, I think a lot of what we're seeing both on the short rate market as well as in the equity market is basically like an all-in bet on soft landing and immaculate disinflation. And all of a sudden, people are starting to say, maybe that isn't actually going to play out as we expected. And that starts to create concern. You're starting to see the 2-year move to some extent. You're seeing the long end move. And you're seeing those commodity prices reaccelerate. And that's the last thing the Fed needs here, right? They've basically committed to be on hold through the end of the year. And if they start to see those commodity prices move, that's really going to start to question the fact that they should continue to be on hold.
So at a time where we're starting to see more economists pare back recession calls, and some of the biggest bears on Wall Street actually start to soften their stances here, this notion of a soft landing, could it be at risk?
Well, I think that this calls into question the general idea of soft landing. The problem with soft landing is it itself is self-defeating, because if you price in the soft landing, you get the lower interest rates, you get the equity strength, and that means that the economy continues to be strong, which means that those inflationary pressures come on, and that then creates the problem for the Fed to need to tighten. And so we're just in that transitionary period where the disinflationary pressures have basically maxed out, and we're starting to see the reemergence. And that's the basic problem with the soft landing narrative in general. It can't exist because inevitably it will create the acceleration that will end the soft landing.
Okay, so it sounds like you like energy, but are cautious, to say the least, on tech here at these levels. How else would you be positioning in this market?
Well, I think it comes down to, it's been a great year so far for the highest beta stocks that are out there, for the growth stocks. And you're starting to get pricing that is pretty extreme relative to history there. Relative to when you look at, the PEs in the energy space are in the low 10s, right? Versus tech stocks in the 40s. You start to see those areas where you have really extended valuation problems, and where, I don't know, NVIDIA is at a 40 times sales. Like, is that likely to realize? Is that likely to happen? And I think as you start to get that market-based tightening, people will start to question whether that can really be realized over the long term. And it doesn't take much of a pullback to start to create the downward pressure on those stocks.